Hello and welcome to ET Market Smart Talk. Well, India's bond market has received a clear policy signal with a rate cut, front-loaded OMOs, and a softer inflation outlook. And as we look ahead to 2026, a key question for investors is how to position their portfolios. Should one lean towards more active strategies or stay with the passive and target maturity approaches? Well, to discuss this, I'm joined by Siddharth Chaudhary, Head of Fixed Income at Bajaj FinServ AMC. Siddhartha, thank you for joining us.
Thank you, Shitesh, for having me on the show.
Thank you so much for taking the time out, Siddhartha. And the MPC delivered a sort of a rate cut and a front-loaded moves as the bond market expected. So, how significant is this alignment between policy action and market expectations?
Okay, so that is the talk of the town right now, the main concern. So, what we have seen across the G10 economies this year, for a reason or other, there is a mismatch in the market expectation and what central banks are doing. For example, in month of June, when RBI gave us a big rate cut of 50 basis point and along with 100 basis of CRR cut, I think both of them were not expected by the market in a great way. 25 basis was best what market was expecting. So at that point of time, it was, the euphoria was curtailed by announcement on stance change, which was very abrupt. Just a policy back, we had, changed the stance. So now, market took some time to digest that, and even after such a deep rate cut, we again had a rate cut a few days back in the month of December. And then in December policy, now this market is trying to time the end of the rate cut cycle. So at end of the rate cut cycle, what happens is the longer end of the curve, where all kind of buyers who otherwise in normal times would not have increased exposure are also there. So everybody has increased the duration. You are in first gear or second gear most of the time. You all of you are in fourth gear right now. So at the end of the rate cut cycle, everybody tries to exit, and that what happens is this. So this is one explanation. There are other things which are playing in the background. Monetary policy, by its action and nature, can only, price and it can only affect the price and the quantity of the money which is there in the market. It helps the short end of the curve. Longer end of the curve, which is the term premium plays out, has all the market expectation built in. So, so that has one factor, which is your currency movement also built in. And you know what is happening on the currency front. We have trade tariffs which are getting delayed. And when people were assuming earlier that by month of December end, we'll have some solution, some kind of solution, partial or full. So that is getting delayed. INR is getting depreciated. And the policy of INR, how government and RBI looks at INR is also a little changed. The intervention, which was very straightforward at the previous regime, is not there right now. So they have, allowed INR to depreciate. So market is coming to the new regime, coming around new regime, and try to price in within the this term premium which is there. So, for example, 2 to 10 year term premium in India at start of this year was around 10 basis point. In US, it was around 24 or 26 basis points, something like that, at the start of the year. Since then, both countries have seen rate cut. They have seen 100, we have seen 125. And today, the spirit of India is from 10 basis points around 77 basis point. And in US, it is around 3 times around 65, 70 basis point. So that shows that what is getting built in this term premium is that word over end of the rate cycle is there, has arrived, and unless there is a crisis or something. And second is that there's a growing dissonance between the policymakers and also I think I should point out this: the whenever there is a political intervention in independent policy making, like we have seen in US. So US is a perfect case. There are 3-4 scenarios where this kind of misalignment happens. All of them are present in US. Fiscal and monetary policy both going in different directions. Political interference and large issuances, fiscal impulse, tax cuts, etc. Everything is here in US. In India, it's just that INR and maybe some policy communication in last June is it passe now. So market understands now the RBI would be there to give the liquidity, but also on liquidity front, there is market would expect a calendar. Market expects too much, from central banks. They expect there should be a calendarized OMO. Every month we should know how much liquidity would be infused. So that kind of communication is still not there because that kind of crisis is still it's not there. RBI doesn't need to do that. But since situation is developing that external liquidity requirement is due from central bank, is required from central bank, people expect that. So whenever this gap is there, you see 10-year yields going 10, 15 basis point higher from previous pre-policy rates. So that is what is playing out right now.
Absolutely. Valid points there, Siddharth. And in fact, the governor's statement has sort of opened space for discussion on further easing. So, what signals should market watch to assess whether more rate cuts are likely or not?
So we are coming from a background where we had a Goldilocks, even more than Goldilocks kind of situation, where we have very low inflation rate. Regularly, the forecast of RBI has been met by the reality where inflation has been reading has been very low. So this may not be the situation going ahead. Now they have a projection of 3.9 and 4% next year, and rates to come to a level. So policy rates have come to a level where they can go low only if there is a crisis or some question is required. You can't keep on reducing policy rate. Now focus is on transmission. So though governor has given very good signal by talking about further easing possibility, I don't think one should look at it as any as the main consideration for creating a portfolio and so, because transmission itself would mean some compression in the spread. So those factors we should look upon. I think that would come from some stability on INR front. A trade deal would be very happy thing to happen as soon as possible. Some regular movements in INR, and then we are there. So that's the idea. And as this continues, people will realize that the spread between 10-year and GSE repo rate is a good entry point as of now. It is assuming too much risk, which may or may not play out in next quarter. That's the idea.
Absolutely. And what impact do the, let's say, 1 trillion rupee OMO have on the bond yields and liquidity in the near term, especially across the yield curve?
Okay, so impact, if you had asked this question a month back to many people, they would have anyone would have said that 1 lakh is welcome, 1 lakh is a good amount, and that would mean some compression in spreads. But as I have just talked about, OMOs have been subsumed by all that negative which is happening. So not much impact. In fact, yields have gone up. In fact, now expectation is that what will be the scenario next quarter? We will need some more OMOs, maybe 2 lakh crores or even higher in next quarter to meet the liquidity requirement. Because FPI outflows are not stopping. So you need liquidity from central bank. So on that front, as soon as RBI comes is better. And why not this quarter itself? Why can't we have an announcement in this quarter by December for a date of OMO can be next month also. So that next communication would help. Yeah.
Absolutely. Valid point there, Siddharth. And in fact, you mentioned about the front-loading OMOs could pave the way for additional liquidity measures next quarter, like you said. So what form could these measures take?
So as a bond holder, everybody would look for OMOs. And anything else, for example, FX swap or something is done, people would start, thinking that means lesser OMOs. If anything else is done, that would mean lesser OMOs. So from bond market perspective, rate trader perspective, you would look for OMOs. For banks and all, there can be many forms, but those tools are deployed in, when there are very difficult times and all, LTROs and all, that is not required right now. So you will find shorter end pay, VRRs are there, and OMOs and FX swap is the major combination of things which can be done. CRR will not be cut now. We are already at very low number. So that's the idea.
Absolutely. And from a fixed income investor's perspective, which segment of the bond market stand to benefit the most from the policy stance?
Okay. So policy stance is rate cuts are almost over, very near to the end of the cycle, maybe one more.
Okay.
And policy
end of the curve.
End of the curve. But what market is offering us right now is a good spread, term premium. So my focus would be not on that 25 basis cut or 5% is going to be reality or not. My focus right now is on the spread of 135 basis point. My studies are telling me 10 basis is the worst case scenario from here, which is also a very, very bad thing to happen at this level. But spread contraction is possible as soon as INR is stable. And also one must realize that we have seen very last 10 years, 15 years, if you look at it, we have seen very high inflation periods. Now those periods are not in picture. So even if you go wrong in your inflation projection for the next 6 months, 9 months, even then you would be somewhere near 4% plus minus 0.5%. So that is what RBI wanted. The inflation targeting has achieved its objective. So that's a good news. That would mean lower for longer kind of environment in India on rate front. That said, that realization and that should act as a catalyst for compression of the spreads. That's the idea. But that catalyst is not visible because of INR. That's that.
Absolutely. And in fact, now we are stepping into the new year, 2026. So does sort of a new year call for higher allocation towards active or passive fixed income strategies? What is your view on that,
First of all, if you look at every asset, you will find one can say that almost all assets are overvalued. You find, there can be a good correction in any asset. You have seen gold run up, silver run up, though fundamentals may be strong, though buying is strong, but good run
Yes.
up has been there. There's been no run up in fixed income. So fixed income is
Yeah.
the idea. And then
Okay.
second is that in 2026,
Yeah.
if I have to create a portfolio, I would definitely not avoid longer duration as of now. The spreads are looking attractive, though I know they can become more attractive. They can be spread, shocks can be there. So I would keep some cash. I would keep 10-20% cash in the portfolio. I would touch upon longer end also
Mm.
to have that possibility in my portfolio where spread compression gives good high return. Otherwise, had this already played out, right now I would
Mm.
be advising in earlier cycles, I would be advising that carry an accrual because now
Mm.
onwards, maybe 10, 11 months, you can see a rate hike cycle and so 2-3 years
Yeah.
kind of duration is good. But right now, this is different.
Absolutely. And lastly, is that if you were building a, let's say, a fresh portfolio for 26 today, what would be your top three fixed income allocation principles?
So the basic is match the duration with your holding period.
The
That's
duration,
fine.
right?
But you can still, if you are, you can take some risk, take risk on longer end, as I pointed out. We'll have
Okay.
kind of a barbell kind of a portfolio, have cash for
Mm.
any eventuality where you can even deploy more monies in
Eventuality.
longer end. So that's the idea. Keep some cash in portfolio and do not miss the longer end. It may be that word over optically all longer ends are
Uh-huh.
attractive. US is attractive, Germany is attractive, Japan is attractive.
Right.
But the
Right.
factors there are not the factors which we have here. They have all
Sure.
fiscal push, which is, challenging all the
Mm. Mm.
equations. You have Japanese rates going up after 20, 30 years. Reverse carry trade
Yeah.
is possible. US Treasury
Uh,
issuances are all-time high. But look at the problems we
mm.
have. We have poor INR, just depreciating because of trade tariffs getting delayed. That
Yeah.
getting solved, our problems are manageable. Our problems are that
Mm.
it may be tax collection target for next year can
Mm.
be if this year can be not be met by a few
Mm.
percentage points. Government would
Sure.
do lesser spending and still manage your 4.5% of fiscal deficit target. So those things
Mm.
are there,
Mm.
but our problems are not unmanageable unless and until this INR gets solved, trade tariff situation gets solved. That's a problem. Yeah.
Absolutely. Well, on that note, Siddharth, thank you for sharing your insights on policy, liquidity, and portfolio strategy. Well, that was a very helpful perspective for investors navigating the evolving debt market space. Thank you so much for taking the time out, Siddharth.
Thank you, Shitesh. Thank you, viewers.
Thank you very much.